President Trump's top White House economic advisor, Larry Kudlow. Larry, welcome back to Fox News Sunday.
Thank you.
All right. The president sends a new budget to Congress tomorrow that will reportedly call for stiff domestic spending cuts in environmental programs, transportation, anti-poverty programs, at the same time that he's calling for a big increase in defense spending, and you've still got those tax cuts. Why do that on the domestic side?
Why not? I mean, if you want to deal with budget deficits, you've got rapid growth, which means keep the tax cuts in place. We believe the 3% growth rate of 2018 will continue in 2019 and beyond 2020 and so forth. I think the other element is always to limit spending, and the president is proposing roughly a 5% across-the-board reduction in domestic spending accounts. It will be a tough budget. We're going to do our own caps this year, and I think it's long overdue. Some of these recent budget deals have not been favorable towards spending. So I think it's exactly the right prescription.
All right. You say that you're going to have a 5% domestic spending cut. On the other hand, reportedly, you're going to ask for another $8.6 billion from DHS, Homeland Security, and the Pentagon to build the wall. So there's going to be another budget fight over the wall?
Well, I suppose there will be. I would just say that the whole issue of the wall and border security is of paramount importance. We have a crisis down there. I think the president has made that case very effectively. It's a crisis of economics. It's a crisis of crime and drugs. It's a crisis of humanity. We have to be much tougher and have more constructive immigration policy, which we will be developing over a period of time. So, yes, he's going to stay with his wall, and he's going to stay with the border security theme. I think it's essential.
Okay. Here's the problem with this. You talk about balancing the budget and that the way you're going to do it is by cutting 5% in all domestic spending. But you know that if you take entitlements off the table, that you just can't get enough from domestic discretionary spending to cut the budget. And your new budget is a case in point. Traditionally, Republican presidents have said, we're going to balance the budget, and our budget, they projected out that it's going to balance the budget in 10 years. Your new budget doesn't balance the budget until 15 years, until the 2030s. And the question I have is, you and I have known each other a long time. When I covered you in the Reagan years, you cared, and you thought that deficits and debt mattered. What happened?
Not overwhelmingly so, by the way, during the Reagan years. Look, I don't think good growth policies have to obsess necessarily about the budget deficits and so forth. Look, Chris, my view, and I believe the view of the administration, we are going to point a steady glide path towards lower federal spending and federal borrowing as a share of the economy, as a share of GDP. That lowers the burden of the
deficit increased by an enormous amount in the first few months of this fiscal year. I think 70%.
We're going to run, I think, about 4.5% to 5% of GDP. That's a very modest number compared even with the recent past and with our long-term
trend. It's going to be close to $1 trillion.
Perhaps so, but the economy is $20 trillion. And net worth today, household net worth is about $100 trillion. So I don't think that's a burden on the economy. And I think all the incoming data. Look, here's something. Let's go to the financial markets. You have a 10-year Treasury bond right now that's about 2.60%, 263, I think, at the close on Friday. If the markets were overwhelmingly worried about our budgets and our spending and our deficits, you would see that interest rate rise. It'd be a greater penalty. I don't see it right now. And again, long run, we do want to reduce the burden of spending and borrowing, absolutely, but always as a share of GDP. And
okay.
I put that, that's the same policies, that's the same approach we had during the Reagan years.
Okay, let's talk about something the markets were worried about on Friday, and that's the fact that you got a bad jobs report, and let's take a look at it. Only 20,000 jobs added in February. The projection had been 180,000 jobs. Good news, wages rose 3.4%, which was the fastest in almost 10 years. Question, are we reaching full employment where there just aren't going to be that many people who want jobs because they already have jobs?
Well, let me say on that number on Friday, the payroll number from the establishment survey was only 20,000. It's a very fluky number. It has a lot to do with the government shutdown and the timing of jobs.
You didn't say that when you had 330,000 jobs the month before.
Well, we didn't have the shutdown issue the month before.
But my point is the number was the number, and you...
And The household survey from which unemployment is derived was 255,000. So that's a big home run. And the unemployment rate fell from 4% to 3.8%, which is very, very important. You noted correctly, wages are up 3.4%. That's a terrific sign. And what's happening as wages have been rising, people are coming now, moving back into the labor force. They're not only coming off unemployment to work at the higher wage rates, but they're actually coming out of the woodwork. People who were not part of the labor force are now coming back. And I think that's very important. Participation rates are very high, and that's a signal that we still have lots of labor resources. By the way, the biggest category of improvement, people coming back to work and supplying their labor, women across the board, and I think that's very helpful.
That was a great number this month. The other concern is that after 10 years of growth, is the economy slowing down? I want to put up some numbers on this. Growth in 2018 went from 4.2% of the second quarter, you can see down in this third quarter, and all the way down to 2.6% in the fourth quarter. And with the economies in Europe and China slowing, there is a growing consensus among experts you're not going to make 2% for the first quarter this year. Do you agree with that you're going to be in the ones for the first quarter of 2019?
I'm not going to score it just yet. I'll take the over on that forecast, as I generally do, by the way.
I was going to say.
I would just say, as long as we keep our policies intact, low tax rates for individuals and businesses, across the board deregulation, lighten the paperwork burden, let small businesses breathe and get a good rate of return. The president has ended the war on business. The president has provided incentives for economic growth. We've opened up the energy sector. Our policies are strong, and I think the growth rates this coming year will exceed these estimates just as they have last year.
The Fed says 2.3% this year. You and the president say 3% growth as far as the eye can see. The Fed says 2.3%.
But we'll see. We had this conflict last year, and the president was right. The Fed was wrong. My colleague, CEA Chair Kevin Hassett, is strongly endorsing his forecast of 3.1%.
Chairman of the Council of Economic Advisors.
Indeed, and a dear friend of mine. And I'm in Kevin's camp. And again, the investment incentives are so strong that I think they're being underrated. Can I just get one number in?
All right, then I want to move to trade deficit.
Yes, sir. Productivity, output per hour, which is in a good market capitalist economy, Democrats take note, productivity is the center of it, okay? 1.8% increase in I couldn't help myself. 1.8% increase in productivity. That's the highest number in many years. We've gone from 0 to nearly 2%. Okay. So I'm going to argue growth and jobs will continue to expand.
You also got some bad news this week on the trade deficit. Here's what President Trump said last June.
We have massive trade deficits with almost every country. We will straighten that out. And I'll tell you what, it's what I do. It won't even be hard.
He says it won't even be hard, but despite his tough policies and tariffs, the trade deficit in goods worldwide last year was $891 billion. That's the biggest trade deficit worldwide in U.S. history. And despite our trade war with China, the deficit in goods there hit a record $419 billion. Some experts say the problem is you just can't tariff away deficits, that the real issue is macroeconomics. And to a degree, what they're saying is that you're a victim of your own success. The tax cuts gave people more disposable income. They spent that buying more foreign goods. Rise in interest rates strengthened the dollar. That made U.S. exports more expensive, and foreign countries made imports into this country, U.S. imports, cheaper. And basically what they're saying is that the president has it backwards, that trade deficits are not the sign of a weak economy. They're the part of the byproduct of a strong economy.
Well, a couple things. First of all, the president's trade reform policies, which in my judgment are succeeding better than anyone thought, he's really talking about free, fair, and reciprocal trade among nations. and we've accomplished the USMCA, the so-called NAFTA 2.0. We're getting closer. We're making a lot of headway on the China trade deal. Perhaps we'll talk about it in another minute. We're negotiating with Europe, and we're negotiating with Japan. So I think his trade policies are succeeding. He's been tough, and sometimes he will use tariffs, something that I've learned that can bring people to the table. Second point, on the trade deficit per se, Chris, I don't think it's either good or bad, okay? Your point is well taken. You have incentives for investment and economic growth. The U.S. is bound to have a trade deficit in goods with the rest of the world because we're growing much faster than they're growing, and so we're buying more of their goods. With respect to Europe, for example, almost flat on its back, near recession. We're the only demand stimulus they have. So that's, yes. On the other hand, we have trade surplus on services, and we have a surplus on net investment income coming into the USA. So I don't want to get too hung up on that. It's neither good nor bad. It just is. But we have to have tough reciprocal trading policies with our neighbors.
Okay. Finally, China, as you predicted. Here is the president in January about a trade deal with China, and then a much less optimistic assessment this week. Take a look.
We're going to have a great trade deal with China if it all works out, and we look forward to it. It's going to be great for both countries.
Yeah, sure, I'm confident. But if we don't make a very good deal for our country, I wouldn't make a deal. If this isn't a great deal, I won't make a deal.
So let's look. The Chinese have reportedly removed a trip to Mar-a-Lago for a signing ceremony in March.
No, you can't cancel something that wasn't scheduled. That's
well,
just
supposedly,
not true.
according to the reports, that was on Xi's schedule, and it's now been taken off. Number one. Number two, the key enforcement issue, enforcing what the Chinese are going to represent, has not been hammered out. And three, the Chinese are reportedly concerned that if there is a summit with Xi, that the president, if he doesn't like the deal, will walk away like he did with Kim in Vietnam. Simple question. How much trouble is a trade deal with China in?
I think we're making great progress. Look, as the president said, across the board, the deal has to be good for the United States, and for our workers and our farmers and our manufacturing. It's got to be good. It's got to be fair and reciprocal, and it has to be enforceable. All right? That's an important point. Secondly, we made great headway when the Chinese were here 2 weeks ago. In the past week, we've been in communications with them every day by teleconferencing and so forth, working out some of the difficult final points. I think that's where we are in the successful negotiations. I don't want to predict. It's up to the president, not to me. But I think the headway has been good. This morning headline, China has accepted our currency proposals to have stable currencies and transparent interventions so that they won't devalue.
I'm running out of time. Simple question. Will there be a signing ceremony between the two leaders either in March or April?
I will play that from the optimistic side. I will take the over on that, just as with economic growth.
Over meaning?
Over meaning good, yes.
Okay.
Positive.
Sometime
Bullish.
Either this month or next.
Bullish.
All right. Thank you. Thanks for your time. It's always fun to talk with you.
It has to be a good deal.
And
it has to be a good deal.
And we'll watch the rollout of the president's budget tomorrow. Thank you, sir.
Appreciate it.